The ATO just updated super contribution rules for 2025, and if you've got $27,000 sitting in cash right now, you're about to miss a $10,000 tax deduction. Most Australians don't even know that number exists. Here's the reality. The average Australian has access to $27,500 in concessional contribution room per financial year. That means you can put $27,500 into super and claim it as a tax deduction. If you're earning $180,000 per year, that $27,500 contribution saves you $8,250 in tax at the 30% marginal rate, plus another $1,650 if your income puts you in the top bracket. So that single contribution saves you roughly $10,000 in tax. Most people don't do it. Why? Because nobody explains the actual mechanism. You have to actively choose to contribute to your own super. Your employer contributes the compulsory super guarantee, which is currently 11.5% of your salary. But that's separate. The $27,500 we're talking about is additional money you can put in yourself and claim the tax deduction. Let's break down what actually changed in 2025 and why you've got 14 days to act. The concessional contribution cap for 2025 is $27,500 per financial year. That's the same as 2024 and 2023. The cap hasn't moved. So if you're thinking the rules changed because the limit went up, they didn't. The rules changed because of how you calculate your available room, and the ATO just clarified how that works for mixed income earners and contractors. If you're a traditional salaried employee, you've probably got $27,500 in available room, unless you've already made concessional contributions this year. But here's where most people get it wrong. You have to actually check your ATO account and see what you've already contributed. Your employer is likely putting in 11.5% of your salary automatically. If you earn $80,000 per year, that's $9,200 going in automatically. That means you've got $27,500 minus $9,200, which is $18,300 remaining in your own contribution room. That $18,300 is the gap. If you've got $18,300 sitting in a savings account right now earning 3% interest, that's $549 per year in interest. Put that same $18,300 into super as a concessional contribution, and you get an $5,490 tax deduction at the 30% rate. That's 10 times the interest you're earning in a bank account. Over 10 years at 7% growth inside super, $18,300 becomes $35,900 instead of staying at $18,300 with bank interest. That's a difference of $17,600 in your pocket at retirement, not in the tax offices. Here's the step-by-step method to actually do this. Step 1. Log into your ATO account right now using MyGov. Go to Super Contributions. You'll see two numbers. One is your total concessional contribution cap, which is $27,500. The other is how much you've already contributed this financial year. Write that second number down. Step 2. Subtract what you've already contributed from $27,500. That remainder is what you can contribute today without breaching the cap. Let's say you've contributed $9,200 in employer super. Your available room is $18,300. That's your number. Step 3. Check your bank balance. If you've got $18,300 or more sitting in a savings account earning less than 5%, this is the financial year to move it. If you don't have that much, contribute whatever you've got. Even $5,000 per month over 4 months gets you a $1,500 tax deduction at the 30% rate. Step 4. Go to your super funds online portal. Every super provider has a member portal. Look for the link that says Personal Contribution or Member Contribution. It's usually in the dashboard or settings area. Click it and select Concessional Contribution. That phrase matters. There are different contribution types, and you want the concessional one because that's the one you can claim as a tax deduction. Step 5. Enter the amount. Confirm the contribution details. Most super funds process contributions within 1 to 2 business days. The money goes from your bank account to your super account. Your fund will send you confirmation. Step 6. When you lodge your tax return before October 31st, you'll claim the deduction. If you're using a tax agent, give them the contribution confirmation email. If you're doing it yourself through the ATO's tax agent portal or MyTax, the contribution will usually appear automatically if you've contributed through your fund correctly. You declare it as a personal contribution, not an employer contribution. That's the mechanism. Now here's the worked example with real numbers. Sarah earns $120,000 per year. Her employer contributes $13,800 in super, 11.5% of salary. Her available concessional room is $27,500 minus $13,800 equals $13,700. She's got $15,000 sitting in a savings account at ANZ, earning 4.25% per year. She puts $13,700 into super tomorrow as a concessional contribution. She gets a $4,110 tax deduction at the 30% marginal rate. She gets $3,900 tax deduction at the 30% rate plus Medicare levy of 2%, which is total tax saving of $4,110. That $13,700 growing at 7% per year inside super over 25 years until retirement becomes $75,800. If that same money stays in a bank account at 4.25% interest, $13,700 becomes $39,200. The difference is $36,600 in lost retirement income because she left the money in a savings account instead of super. Plus she paid tax on the interest. That's not financial advice. That's just how the maths works with the numbers the ATO publishes, and what banks are actually offering right now. Common objection number 1. I heard super is locked up until age 60. Yes, that's correct. Your super can't be accessed until your preservation age, which for most people is between 55 and 60. So only do this if you genuinely won't need the money before retirement. Don't lock up money you'll need in the next 5 years. Common objection number 2. I've already made contributions this year, and the ATO said my cap was full. That's possible. Your cap resets on July 1st. If you hit your $27,500 cap on June 20th, you have to wait until July 1st to contribute again. But if you haven't hit the cap, you've got room between now and June 30th. That's 14 days. Common objection number 3. I'm self-employed and don't get employer super contributions. You've got the full $27,500 available to you, assuming you haven't already contributed. This is a massive opportunity for self-employed people. Contribute $27,500, claim the tax deduction at your marginal rate, which might be 37% plus Medicare levy if you're earning well, and suddenly that contribution cost you 45% less than you think. Here's the deadline that actually matters. The financial year ends on June 30th. Any concessional contribution you make on or before June 30th counts toward this year's tax return. That means you've got 14 days from now to make the contribution. The money has to leave your bank account before June 30th. Most super funds will confirm it's been received within a couple of days, so you've actually got a bit of buffer. After June 30th, you've missed the opportunity for this financial year. You'll have to wait until July 1st when the next year's cap opens up. Here's your action plan for the next 24 hours. Log into your ATO account and check your concessional contribution cap and how much you've already used. The number takes 30 seconds to find. Write it down. Check your bank balance. If you've got cash sitting around earning less than 5%, you're a candidate for this. Log into your super fund portal and find the personal contribution section. If you can't find it, call your fund. They can walk you through it. Do this today if you can. The sooner you start the clock, the sooner the money is growing in super instead of earning nothing in a savings account. This isn't complicated. It's just that nobody explains the actual numbers. $27,500 per year in contribution room. $10,000 in potential tax savings. 14 days until the financial year ends. That's the entire story.